Welcome to this explainer. Today, we are absolutely unpacking the Edelweiss Midcap Fund. We're going to cut right through the usual market noise and look strictly at the hard data to understand its mechanics, its historical performance, and, most importantly for us, its true risk profile in a highly dynamic market.
So here is our roadmap for today. 1. Defining midcap mutual funds. 2. Edelweiss Midcap historical performance. 3. Beating peers in the benchmark. 4. The fair investment advantage. 5. Risk metrics and market volatility. And finally, 6. Assessing long-term capital growth. Let's dive in.
All right, starting with Section 1, Defining Midcap Mutual Funds.
Okay, just to quickly baseline us here, by definition and per market regulations, these funds have to focus their assets on mid-sized companies, meaning they must invest a minimum of 65% of their total assets specifically in mid-cap equities. These are the companies sitting right in that absolute sweet spot of their business life cycle.
As you can see, midcaps sit in a really unique growth phase. They're typically proven ideas that have safely graduated past that highly speculative, risky small cap phase. They've actually transitioned into real, breathing businesses that are experiencing high earnings growth, way before they consolidate into those slower-growing, massive large caps.
And the sheer momentum driving this segment right now, it's literally incredible. According to Edelweiss AMC's CIO of Equities, Trideep Bhattacharya, mid-caps are currently seeing double the earnings growth rates of large caps. So even if valuations might seem rich at times, that raw underlying earnings growth is a massive engine for any portfolio.
Moving on to Section 2, Edelweiss Midcap Historical Performance.
So let's look at the actual numbers. The fund has consistently delivered some really strong compound annual growth rates. While the one-year return sits right around 7.79%, the real magic is in the long term. It has delivered over 24% in the 3-year window. And since its inception way back in late 2007, it has compounded at an incredibly impressive 21.51%.
Now, mid-cap funds are supposed to be the ultimate proving ground for active management, right? Yet so many of them fail to consistently beat their benchmarks over long periods. But get ready for this staggering data point. Over 5-year rolling periods since January 2018, this Edelweiss fund has beaten its benchmark 91% of the time. 91%. No way around it. That is seriously impressive.
Which brings us to Section 3, Beating Peers and the Benchmark. When we actually pit the fund against heavyweights like HSBC, ICICI, Nippon, and Sundaram in real-time competition, Edelweiss holds a highly competitive position. With the 3-year return hovering near 22%, it sits firmly in the top tier of what is honestly a very crowded market. And when contrasted directly against its primary benchmark, the Nifty Midcap 150 Total Return Index, the fund demonstrates sustained alpha. And it's absolutely vital to understand this isn't just some episodic, short-lived brilliance during a bull run. The data shows its underperformance phases are remarkably limited in both depth and duration.
Let's look at how they do this in Section 4, the fair investment advantage.
So you might be wondering, how exactly does the fund manager consistently find these opportunities and beat the benchmark? Because notably, and this is key, this fund doesn't try to time the market by jumping in and out with cash calls.
Well, the answer lies in their proprietary FAIR framework. This is a super disciplined strategy that focuses purely on identifying robust, clean businesses that are available at the right acceptable price. They consciously avoid being boxed into a specific style bias. They maintain enough portfolio liquidity to handle market fluctuations. And crucially, they stay fully invested through all market cycles. No trying to catch the falling knife here.
Looking at the overall portfolio allocation, they dedicate nearly 77% to mid-caps, which perfectly aligns with their mandate. But check this out. That roughly 12% in large caps and 11% in small caps, it's highly strategic. Instead of selling prematurely, they actually hold on to their mid-cap winners that have successfully scaled up, allowing investors to capture that entire long-term growth story.
Okay, Section 5, Risk Metrics and Market Volatility. Let's demystify some of these heavy quantitative metrics for a second. Standard deviation sits at 15.39%, mapping out the expected spread of returns. But beta is the real key here. Think of it as the market's roller coaster track. At 0.94, this fund actually has a slightly lower beta than its category, meaning it doesn't artificially increase your sensitivity to market bumps. Meanwhile, an impressive 2.64 alpha proves the manager is speeding up your wealth accumulation without taking on outsized, crazy risks to do it.
Bringing it all together in Section 6, Assessing Long-Term Capital Growth. According to the source documents, the riskometer for this fund sits undeniably at very high risk. This is a stark reminder to all of us that despite excellent active management, midcaps are volatile by nature. Let's be real, this is absolutely not the place to park short-term cash you might need to pay rent next month.
So, to safely navigate this inherent volatility, the strategy for beginners or really any conservative investors watching is clear. First, adopt a minimum 7+ year horizon. Set it and forget it. Furthermore, utilize systematic investment plans, or SIPs, to average out your purchase price over time. This helps you mechanically absorb those interim sharp declines without panicking and hitting the sell button.
And remember, patience pays off in taxation too. If you hold your units for over a year, gains up to 1.25 lakh rupees are totally tax-free, and anything above that is taxed at just 12.5%. But try to pull it out in under a year, and boom, you are hit with a 20% tax on the entire gain. Plus, there is no tax paid while you're simply holding the units. This tax structure heavily reinforces that buy and hold strategy.
Which leaves us with one final, absolutely crucial thought. You've seen the 91% rolling return success, we talked about the disciplined fair framework, and we went over the very real volatility warnings. So does this structured approach to midcap growth align with your own personal timeline and stomach for long-term wealth creation? Because ultimately, that is the big question you have to answer for your own portfolio. Thank you so much for joining me on this explainer, and keep learning.